Hi everyone, this is going to be the last video in our Chapter 2 Excel homework series, and this will be Excel homework number 6. And let's take a look. So in this problem, we've got this company, the company's manager estimated 2025's total direct labor cost, assuming 100 people working an average of 2,000 hours each and an average wage of $25. And then the manager also estimated the following manufacturing overhead costs for year 2025. So this is kind of before the year begins, right? This is how we are going to be running up to creating the predetermined overhead rate. And so again, we're sitting here as accountants and managerial accountants and stuff, trying to forecast, and budget for the upcoming year. And so we put together this budget essentially, and our total estimated overhead costs with all of these individual amounts, utilities, insurance, depreciation, repairs expense, supplies used, miscellaneous, all kinds of stuff. And the total that we think we're going to spend next year on overhead is $1,512,000. Okay, now using the templates below, we want to calculate the total estimated direct labor costs. So this is the total estimated overhead, but then it gives us some of the information above to calculate total estimated direct labor costs. So the number of employees, as it says above, is estimated to be 100. We estimate they're going to work 2,000 hours per year. And then the estimated number of hours worked is just, multiply those together. So we think there's going to be a total of 200,000 hours that we're going to need to pay our employees next year. And then we can just bring this down. This is that total number of hours. And the average estimated wage rate would be $25. And so then we just multiply how many hours in total all of our employees are expected to work, and then how much our average rate is expected to be. And so we have an estimated total direct labor cost of $5 million for our company. Okay, that's good information to have, and we're going to need that to calculate our predetermined overhead rate. And we'll do that here in step 2. So now step 2 says calculate the predetermined rate using the template below, and note that overhead will be applied as a percentage of direct labor costs. Okie dokie. So total estimated overhead costs, again, that's just here, $1,512,000. And then estimated total labor costs is $5 million. And so then we want to take and try and figure out, so for our base here is direct labor costs. So for every direct labor cost dollar, then we can expect 30%, or 30 cents basically, if you want to think of it that way. But for every direct labor dollar that we incur on a given project, we're going to multiply that by 30.24%, and that's going to be our allocated estimated overhead that we apply to that job, right? So we've now calculated our own predetermined overhead rate at 30%. Okay. And so now let's assume we had all these different jobs here, and these were the actual direct labor costs for these jobs. Then just like I mentioned, the way that we would apply that overhead is to take those direct labor costs and multiply them by 30.24%. Now I'm going to show you a little Excel trick here. I'm going to click F4, and when I do that, you could also just manually put these dollar signs in, but when I push F4, you can see how these dollar signs come up. That means that it's going to lock this cell here at B28. And so as I drag this formula down, I want to drag it down so that it keeps multiplying 30.24. I want to move this down, but I don't want to move this one. So that's why I put these dollar signs in, because it's going to lock this cell so that when I drag this formula down, and I can double click, and now it's moved down because I dragged it down. But this one doesn't move because I put the dollar sign, so it keeps using that same 30.24% every time. And that's just a fast way you can then, do all of those without having to manually put all those formulas in. And our total cost, or our total applied overhead costs, I should say, comes out to $892,382. And so if this was our actual ending results of our operations for the year, it'd be kind of interesting too, because we have quite a bit less cost than we expected. From a labor cost perspective, we only incurred actual costs of 2.9 million. We thought we'd have 5 million. And so let's analyze and see where we come out at with under or over applied, essentially. So step 4 is complete the T account for manufacturing overhead and determine whether we are under or over applied. And note that the actual overhead incurred during the year not applied was $865,000. Okay, so that's important. We need this number, $865,000. This was the actual amount that we paid for overhead, right? We didn't end up spending 1.5 million. We actually ended up spending 865,000. Okay, so we still need to analyze this all and figure out. And one thing you kind of see right off the bat, if this is our total applied overhead, this is our actual overhead. The actual is lower than the applied, so we are a little bit over applied. We can already see that now, and that kind of makes us a little bit happy, at least more happy than if we were under applied, because that means we passed on the overhead cost, the actual overhead costs to our customers, and then a little bit extra because we were above what we the amount we passed on as an estimate was greater than what our actual amount. We came in a little under budget, maybe is a good way to say that. Okay, then we're going to link up to each one of these overhead applied amounts, because this is all going to be credits to manufacturing overhead throughout the year as those jobs are being worked on. And then we just add up both sides of the T account for manufacturing overhead. We subtract the bigger from the smaller side, and then we end up with 27,382 of a credit balance, and we can then say that we, as I just mentioned before, were over applied. Another way to think of that is we came in under budget on our overhead, so kind of a good thing. And really what you want to think about, this is nice to have that buffer, but sometimes that could go the other way very easily because maybe a big repair happens that you didn't foresee coming or some other situation arises. So it's not like this is just going to save our company because we were a little bit over applied. Really, that just gives us some buffer next year if we're under applied and some situation occurs that we didn't foresee, because it's impossible to really tell the future and know exactly what are all the overhead costs you're going to incur. This just kind of gives us a good buffer as we go forward. So something to think about. Okay, finally, we just want to close out overhead to cost of goods sold like we do at the end of the period. So we've got a credit balance in overhead, so we're going to want to debit that. Shoot, I'm just going to link so I don't have to, rather not type as little as I can. So manufacturing overhead account, it has a credit balance before closing it out, and so we want to debit that for that amount, which will close it, essentially. We'd be debiting here. I'm not going to put it in the T account, but if we did this journal entry into the T account, it would go here, and then that would just zero out. And then as per usual, cost of goods sold is the account that we close to. And if you remember, cost of goods sold is an expense account, that reduces, we take revenue minus cost of goods sold to get gross profit. And so what we're doing here is we're closing out this overhead and we're crediting that cost of goods sold expense account. If you remember your dead circle, expenses go up with debits and therefore they go down with credits. So in essence, what we're doing with this credit to cost of goods sold is reducing our cost of goods sold and increasing our gross profit, thereby. Because cost of goods sold goes down, sales revenue minus cost of goods sold is gross profit. And if cost of goods sold is decreasing, we're making more profit, which is really what's happened. We're just reflecting that in the accounting records because, like we said before, we came in under budget. So our estimates are what cost of goods sold is originally based on, because we're using that as job costs, our estimated amounts that we allocate. So then we get to the end of the period or the end of the year and we say, okay, let's true this up what our actual cost of goods sold was. And here we say, our cost of goods sold was a little bit too high because we were estimating it was going to be $865,000. Therefore, our gross profit's a little too low. So once we do this adjustment, it reduces cost of goods sold and increases gross profit. Again, just reflecting the fact that we came in under budget on our overhead accounts. So nothing to, write home about with being under budget a little bit, except that that's a good result, generally speaking. As I mentioned, often you'll be under one year, then you'll be over the next. So the biggest factor I would say in the real world when you're seeing variances like this is you just want to make sure it's not like extreme in any one direction, because if it's extreme in the fact of being under budget, that means you might have messed up your budgeting in the first place too. So, just something to think about. But it's the worst situation is if you come in over budget on overhead significantly, because then it was like, then the CEO comes to you and says, what the heck, what did you miss? You didn't account for this correctly. And, turns into a whole thing. So hopefully that's not you, but that's the reality of being an accountant in the working world is you try to do your best, and sometimes it can be a challenging job. But if we have systems and we're smart people and we know what we're doing, like you're learning here, you can do a really good job and keep these variances pretty low. So, all right, well, that wraps up our series on Chapter 2 Excel homework. Hopefully you all enjoyed the videos, and I will see you in the next video or in class. All right, thanks, everybody. Bye.